Hi, welcome back to Hospitality Accounting. We're all the way to Chapter 3, so we're moving right along. Today we're going to talk about financial statements. Financial statements are very important because they're the way we show others, generally investors and creditors, about our financial information. We can show things about revenue, the money we're making, expenses, the money we have to pay, things we own, debts and other amounts we owe, and we can track where our cash is going. So it's an extremely important tool are the financial statements, and we're going to take a cursory look at them all in Chapter 3, and then as we continue through your text, we'll look at them all in great detail. So let's get started. So we're first going to start with the statement of income. Sometimes this statement is also called the results of operations, and it really covers a period of time, such as a month, a quarter, or a fiscal year. A fiscal year is just what it says. Instead of being a calendar year, January through December, a fiscal year will have a different time period. My husband works for FedEx. Their fiscal year end is May 31st. They like to stay away from December and January because that's their very, very busy time of the year. Some businesses, especially in hospitality, restaurants in particular, like to have the exact same number of days in the month. So instead of going from January 1st to January 31st, every month will have 30 days. So that creates a moving end of year. Your fiscal year won't be the same because 365 is not easily divisible by 30. But that is common in hospitality. When we talk about revenue, we really focus on revenue and expense. Revenue is earned when products such as food or services like lodging is sold. Expenses such as cost of sales and operating expenses are the cost to create product or services. So if you want to think about a restaurant for a second, the cost of sales would be the food. For a hotel chain, you would have expenses related to your business, electricity, water. A lot of the utilities are big for lodging. And then you'd also, for both, have wages and that type of cost. So the statement of income will show revenue and it'll show expenses so that you can understand if you are making money. Next, we have an income statement for you to take a look at here. And what you can see is that we start with the heading. The heading is the who, the what, and the when. So the who is the name of the business. I have Luigi's here. The what is the what kind of statement. This is the income statement. And the when for an income statement's a period of time. So it'll say for the month ended August 31st, 2012. You can see that there. And we start with revenue. Here we have food sales and beverage sales. They may be kept separate so that we can track. Next, we're going to have cost of sales. So this relates to any cost. So if you're buying steak, if you're buying flour, if you're buying sugar, if you're buying vegetables, all those would be food costs. And then your beverage costs, obviously you're not brewing Miller beer, or you're not brewing rum, you're not making Coca-Cola, so your beverage costs would go here, and we would compare revenue first to cost of sales and get gross profit. Gross profit is very important because the bigger that is, the more money you'll have at the end. The smaller that is, the smaller your other expenses and everything else will be. And so you want to make sure that you charge enough to cover not only the cost of the items, but these other operating expenses. Here we have salaries and wages, employee benefits, china, glassware, and silverware. So if you're expensing those types of things. Laundry and dry cleaning. Many businesses, especially restaurants, launder and dry clean their uniforms for their employees. Credit card fees. Credit card companies charge a fee every time a customer uses it at your business. They don't charge the customer, they charge you. Advertising, utilities, repair, and maintenance. And then we show some fixed charges like rent, property taxes, insurance. Depreciation and amortization is a little bit more of a complicated thing. It's part of the matching principle, and we'll deal with it, of course, later in the course. And then we have income before taxes. I know all of you know what income taxes are. And then an income tax, and finally net income. Net income is what the business has made for the period. And this is for a month they made $25,000. $900. So after they started with their revenue, they took out all of these expenses, they paid their income taxes. This is what's known as the bottom line. The next statement we're going to talk about is the balance sheet. It is for a single date and time because it is showing a snapshot of the business on a particular day. It has things about what is owned and what is owed, so that kind of makes sense. If I think about my own wallet, I may have some cash in it, but then I go to lunch and I spend some cash and I have less. So my cash is for a single date and time, and that is what I own. And then also it shows what is owed, your debts. And it's based on the accounting equation that we talked about way back in Chapter 1, that assets are equal to liabilities plus owner's equity. Here's an example of a balance sheet. So we have assets. Assets are what are owned, and we show current assets, and we'll talk about more about what makes them current in the next chapter. We have quite a bit more information there. So we have cash and accounts receivable is money owed to us from the customer. Inventory, Luigi's is a restaurant, so inventory would be his food, his drinks, all those items. Prepaid expenses, many times you have to pay in advance. You can think about your insurance for your house or your car. They require you to pay your insurance in advance. And then we have some more assets like land, building, furniture, equipment, your silverware. All of those are things owned by the business. Those are all our assets. They have value. And then down here we come to our liabilities. That is what's owed. And you can see we have accounts payable. That's when we owe someone else. Sales tax payable. When we charge sales tax, we have to remit it back to the county or the state. Accrued expenses, which we'll talk about later. Here's a mortgage payable. Those are all debts. And then we have owner's equity. So we call what the owner owns is capital. So all of these assets, less these liabilities, are here for our owner's capital. The $43,000 is what's known as net assets, what they actually have after paying all of their debt. And whenever you do this, your total assets and your total liabilities and owner's equity, you may notice I have them in yellow, should always be equal. That's why it's called a balance sheet. It balances. Assets must equal liabilities and owner's equity. So next we have the statement of owner's equity. This statement covers a period of time like the income statement. It outlines changes to owner's equity. And if you're doing one for a corporation, it's called statement of shareholders' equity, and would outline the changes to the shareholders' accounts, including the different kinds of stock. Finally, we have the statement of cash flows. The statement of cash flows is extremely important. And it's become even more important through time. It's a fairly new statement. It's showing up somewhere in the 1980s. But what it does is it shows where the cash is being earned and spent, and it reconciles cash from the beginning of the year to the end of the year, and has three major categories: operating, investing, and financing. Operating is generally anything that happens with the core business. So if you're selling spaghetti, if you're purchasing beer, if you're paying your employees, anything in the normal operations of the business goes in operating. Investing generally has to do with buying equipment, and financing deals with loans and the owner's equity if the owner were to put in money. So I hope this helps you with your study of Chapter 13. Thank you for watching. Please be sure to read Chapter 3 in your text because obviously it is more in depth than a PowerPoint presentation. And since you've finished this video, it's time to make sure that you've completed all of your reading and work on your assignments. So your assignments are in Module 1 in Blackboard. Please make sure that you work on them and submit them on time. This is an accelerated course, so it would be great if you took out a calendar and kind of planned your time and when you were going to get everything done. And I know that you will, so I'm just reminding you to do so. I hope you have a great day. Thanks.